Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi ta'ala wabarakatuh. Today, our group will present topic 6 from our syllabus in Islamic investment subject, which is risk and portfolio management. Our group consists of 3 members. The first person is Sayyid Umair bin Syed Ahmad Aljunid, followed by Muhammad Hazeem bin Zakuan, and lastly Muhammad Farid Rusyaidi bin Lut. And here is our table of contents. Firstly, we will start off with introduction. Second, risk and return trade-off. Third, sources of risk. Fourth, measurement of risk. Fifth, risk reduction through diversification. Sixth, portfolio of investment. And lastly, conclusion.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Sayyid Umair bin Syed Ahmad Aljunid, and I will be presenting about the introduction for our presentation for today. So, what is portfolio risk management? Bismillah. So, first thing first to talk about is the definition for portfolio risk management. Portfolio risk management is a process to identify, assess, measure, and manage risk within the portfolio, where the portfolio risk management analyzes portfolio risk, which is to reduce threats to a minimum or a desirable level. The purpose is to reduce the negative impact of activities, events, and situations on a portfolio, while also capitalizing on future possibilities. Overall, for the portfolio risk management, the goal is to maximize business value delivery. The important success factor in an organization's ability to deliver more business value. And organizations that manage portfolio risk are better equipped to take on more risk, increase portfolio value, and have a higher rate of successful project delivery.
This risk and return trade-off topic will be explained by Hazeem.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Hazeem bin Zakuan. Okay, now I will share about the risk and return of trade-off. Okay, firstly, the potential profit returns often influence individuals when making decisions to the point of overlooking one of the most important things in investing, which is risk. So, what's meaning of risk and return in trade-off? Okay, firstly, risk in investment can be defined as the probability of receiving a return less than what was expected, or in other words, incurring a loss. However, risk is actually one of the important aspects in investing that every investor needs to understand. As we all know, the higher the risk of an investment, then the higher the return for that investment. However, investors must always be aware that each instrument has different risks and returns. Therefore, you as an investor should do research before making an investment, and always be prepared with all the risks that will be faced in the stock market. In fact, the risk is inevitable. Okay, and lastly, investor can assess, analyze, and subsequently manage investment risk well if they understand each type of risk. Okay, next we move on to return in trade-off. The return in trade-off refers to the rate at which a company generates a return on investment in a period of time when compared to the cost of investment made by the company, and it is calculated by dividing the return on investment in that period by the cost of investment. In simply put, It is income earned by investing in asset and is mostly measured in percentage terms. It can be negative is net loss or positive is net profit. And it also is measured periodically, such as quarterly, monthly, and or annually. Rate of return on investment is the first and most important criterion that a person evaluates before making an investment decision. This is simply an additional yield on the investment made or a decrease in the cost of the investment over a period of time. And lastly, for entities whose debt or equity shares are listed on a recognized stock exchange, investment returns are very useful from an investor's point of view.
These sources of risk topic will also be presented by Hazeem.
Okay, next we proceed to the source of risk. Threat of risk refers to the uncertainty or potential loss inherent in and trade-off. In the question of risk, there are several types of risk. The firstly is market risk. Okay, market risk is an unavoidable risk when making an investment. There are three main types of market risk that investors need to consider, namely equity risk. Equity risk is a loss when stock price fall. The second one is interest rate risk, is loss due to interest rate change, is usually in the bond market. And the last one is currency risk. Currency risk is loss when exchange rates change currency. Okay, the second one is about the inflation risk. The purchasing power risk is the factor that affects all the securities. It also refers as the likelihood that the purchasing power of the invested dollars will fall. Even if the nominal return is safe, the real return involves risk with uncertain inflation. The risk is associated with the interest rate risk because the increase in inflation result in the increase in the interest rate. Okay, next about the financial risk. The utilization of debt financing by companies includes the financial risk. When more assets of the company are financed through debt, then the variability in the return is enhanced, provided other things keep equal. Financial leverage is associated with the financial risk. Fourth, business risk. Business risk is the risk of conducting business in certain industry or environment. For example, the traditional telephone powerhouse AT&T confronts many challenges in quickly changing telecommunication industry. And last, about the country risk. In current years, country risk is regarded as one of important risks for investors. While investing internationally, the investor should consider the political and economic stability and viability of the country. Countries should be judged on relative basis by considering the United States as a benchmark because this country have a lowest country risk.
And so, the third thing we'll be discuss about today is the measurement of risk. So, what are the ways to measure risk? And so, for the measurement of risk, there are five famous measurement tools that I have provided in the slide, which is alpha, beta, R squared, Sharpe ratio, and standard deviation. The first one is alpha, which it measures risk relative to the market or a selected benchmark index, while beta, it measures volatility or systemic risk of a fund in comparison to the market or the selected benchmark index. For the R squared, it measures the percentage of an investment's movement attributable to movements in its benchmark index, while for Sharpe ratio 2, it measures performance as adjusted by the associated risk. And for the last one, which is standard deviation, it is a method of measuring data dispersion in regards to the mean value of the data set and provides measurement regarding an investment's volatility.
This topic of risk reduction through diversification will be explained by Farid. Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is Muhammad Farid and today I will resume this presentation to the next point, which is risk reduction through diversification. So the first thing that we want to explain is what is risk reduction. Risk reduction is one of the four main risk management techniques to be used in conjunction with other techniques to help an individual or organization effectively manage the risk of loss. Risk reduction also refers to the way an insurance company or organization can reduce its financial loss by implementing measures that reduce the financial impacts of potential loss. As we know, techniques can be things that will prevent certain risks from arising, minimizing the frequency or number of times that risk can actually happen, or even minimizing the damage caused when a loss inevitably does occur. Next, we will give some specific example in terms of investment. For example, an investor already owns oil stock. There is political risk associated with the production of oil, and oil stocks also often have a high level of unsystematic risk. These investors can actually reduce risk by diversifying their portfolio by keeping their oil stocks while at the same time buying stock in other industries, especially those that tend to move in the opposite direction to all equities. Next, I will explain about what is diversification. Diversification is a technique that reduces risk by allocating investment across various financial instruments, industries, and other categories. It aims to minimize losses by investing in different areas that would each react differently to the same event. Also, although it does not guarantee against loss, diversification is the most important component of reaching long-range financial goals while minimizing risk. Next, we will look on to the ways to diversify. The first way to diversify is investing in multiple asset classes. For example, you have invested in variety of multiple asset classes such as equities like stock, fixed income like bonds, and cash equivalent or other money market instrument. The second way to diversify is to invest in multiple assets within each asset classes. This means, as for the first way, we start to invest within the broad categories such as stocks or bonds or any other money market instrument. But in this second way, we started our investment within the subcategories such as consumer goods, pharmaceutical, energy, technology, and others. Besides the common asset classes that we already know, like stock or bonds, there are also alternative asset classes such as real estate and valuable inventory such as artwork, stamps, and other tradable collectibles. Let us take a look to the next topic, which is correlation diversification. Correlation here means an mutual relationship or connection between two or other things. In terms of this correlation diversification, as we know, diversification works best when assets are uncorrelated or negatively correlate with one another. So, if some of the part of the portfolio fall, the others will rise. For instance, Price of financial asset like stock and bonds and physical asset like gold may move in opposite direction due to inflation. High inflation may lead to a rise in gold price, whereas it may lead to a fall in price of financial asset. Here, correlation represents the degree of relationship between the price movement of different assets included in the portfolio. Next, I will explain on why diversification is important. Diversification is a common investing technique used to reduce your chances of experiencing losses. By spreading your investment across different assets, you are less likely to have your portfolio wiped out due to one negative event impacting that single holding. Instead, your portfolio is spread across different types of assets and companies, preserving your capital and increasing your risk-adjusted returns. This portfolio of investment topic will also be explained by Farid. What is an investment portfolio? Investment portfolio is a set of financial assets owned by an investor that may include bonds, stocks, currencies, cash and cash equivalents, and other commodities. Further, it refers to a group of investment that an investor uses in order to earn a profit while making sure that capital or assets are preserved. We will proceed to the next topic, which is components of a portfolio. In a portfolio, there are three components, which is stocks, bonds, and alternative investment. For stocks, it refers to a portion or share of a company. It means that the owner of the stock is also a part owner of the company. The size of the ownership stakes depends on the number of shares he owns. Next is bond. Bonds is a fixed income instrument that represents a loan made by an investor to a borrower. For example, when an investor buys bonds, he is loaning money to the bond issuer, such as the government, a company, or even an agency. For the alternative investment, it may be an asset whose value can grow and multiply, such as gold, oil, and also real estate. Next, we will discuss about the types of portfolio. Portfolio has three different types, which is growth portfolio, income portfolio, and also value portfolio. The first one is growth portfolio. As we look from the name itself, a growth portfolio aims is to promote growth by taking greater risks, including investing in growing industries. Second is income portfolio. Generally speaking, an income portfolio is more focused on securing regular income from investment as opposed to focusing on potential capital gains. The third is value portfolio. For the value portfolio, an investor takes advantage of buying cheap assets by valuation. They are especially useful during difficult economic times when many businesses and investments struggle to survive and stay afloat. Next, we will discuss about steps in building an investment portfolio. To create a good investment portfolio, an investor or financial manager should take note of the following steps. The first step is to determine the objective of the portfolio. Investor should answer the question of what the portfolio is for to get the direction on what investments are to be taken. The second step is to minimize the investment turnover. As we know, some investors like to be continually buying and then selling stock within a very short period of time. They need to remember that this action can increase transaction costs. The third step is don't spend too much on an asset. Here, the higher the price for acquiring an asset, the higher the break-even point to meet. So, the lower the price of the asset, the higher the possible profit. The last step is never rely on a single investment. As the old saying goes, don't put all your eggs in one basket. The key to a successful portfolio is to diversify your investment. When some investments are in decline, others may be on the rise. So, holding a broad range of investment helps to lower the overall risk for an investor. Understanding portfolio. In this topic of portfolio of investment, these were the key points that we need to take a look on. The first one is Portfolio is the collection of financial investment like stocks, bonds, commodities, cash and cash equivalents, as well as their fund counterparts. Second, stock and bonds are portfolio's core building blocks. The third one, a person's tolerance for risk, investment objective, and time horizon are all critical factors when assembling and adjusting an investment portfolio. The fourth is diversification is a key concept in portfolio management.
And so, we have come to the end for our presentation for today. The conclusion will be risk and portfolio management act as one of the primary success for companies in taking better risk and making crucial decisions in taking risk. Assessing the risk levels, organizations can take on more risk and therefore increase the overall value for their portfolio. By measuring portfolio risk and proactively managing it, will reach a greater success and can maximize its portfolio value. So that is all from us. Thank you for listening.